their due diligence and scrutiny want to invest in, it often led to the IPO being subscribed or having greater chances of success. Just like probably if you put up a candidate who is very well acceptable, and since we are in a post-election or election scenario, it gives you a better feeling, and projecting a particular candidate has probably given a better party a better chance at the polls. Similarly, if you were to make a private placement to the FII, then to that extent there was this better chances of the IPO getting subscribed. So the rules were, earlier you had to go to the RBI for every such private placement. Then the rule was relaxed by saying that even if you were to make a private placement, then you could go to the, this could be under the automatic route. But the only point is that the pricing guidelines, because once this was really opened up and no permissions were required from the RBI, only thing that was put in place was the pricing guidelines. And in case of a public offer, whatever was being offered to the residents, you had to price it at least at that particular price. And in case of a private placement, you had to relate to the SEBI or the DCF guideline. At that point of time, it was the CCI value. Now it is the SEBI or the DCF method. And as you probably know, in terms of the new RBI policy, they are probably saying that we will do away with the pricing guidelines, even with DCF and all others. So we'll have to await an official announcement to that effect, official change in the notification to that effect. But this is something which was possible. For an FII, a short selling or borrowing of securities has been permitted in terms of the guidelines. And after you make your investments, then clearly you can repatriate whatever monies that you have made in relation to those investments back home. A special rupee account has to be opened, which the SEBI in its consolidated approval gives you the permission for, and then you can repatriate that amount. In terms of reporting, the entire investment in relation to FII, the responsibility has been thrust on the authorized dealer, because the authorized dealer or the custodian are the ones who are really in touch with the FII and the broker, and therefore the entire responsibility is being placed on them. They have to then give this report from time to time, and that is an onerous responsibility, because you have to ensure that whatever is the FII investment is within those various caps that we saw in the earlier slide. So that entire thing, the onus is on them. I made a mention of that once the FPI regulations have been modified, FII regulations will stand repeat. However, till 1st June, the FII regulations, at least in terms of the RBI's scheme, if you have an application between now to 1st June, they will still process it under the FII regulations. And after that, three type of investors, portfolio investment, the QFIs and the FIIs will all come into one and be called as FPIs. FPIs could also have a third category, which are sovereign funds and other funds, and therefore that is proposed to be broad-based. In terms of income tax, as you know, you have a special section 115AD which governs the tax in relation to FII, the trade, the purchase and sales that they make. Other than the fact that you can rely on the tax treaty, and you may take a position that I'm only a trader in shares, I don't have a PE in India, that position is probably likely to die down soon. But you have your provisions. Similar provisions will have to be made, or instead of the FII, an FPI will also have to be notified in order to give effect to the provisions of the Income Tax Act to the FPI regulations also. This is a new schedule which has come in very recently in 2014, and which is to give effect to the SEBI FPI regulations. And here again, as you will see, as I mentioned, FPI and RFPI is only old wine in a new bottle. So what was FII and some others is now an RFPI, and therefore the principle in relation to the holding of investment is more or less the same. So the 10%, each RFPI will have 10%, total holding of all RFPIs together cannot exceed 24%. Amount of consideration has to come in from abroad, and then you have a foreign currency account. The custodian and the banker will then allow you to repatriate whatever monies you have made in relation to portfolio investments that you made. What are the eligible securities? Purchase of shares and convertible debentures. Right, sorry. Now we then move on to NRIs. The NRI portfolio investment scheme and purchase of shares in convertible debentures. And as I explained to you earlier, this was the first category of investors which was given the benefit of accessing the stock markets under the portfolio investment scheme. So you have purchase of shares and convertible debentures through the stock exchange. It could be either on a repatriation basis or on a non-repatriation basis. One would wonder that if I can do it on a repatriation basis, why would I want to do it on a non-repatriation basis? But you must understand that when these regulations came in, as I told you, they came in much prior to 1991, and at that point of time, a lot of investment was really on a non-repatriation basis, because the government was not very confident about the rupee and its flight, and hence they said, okay, you can come in, but your capital will get blocked to that extent, and therefore the investment will be on a non-repatriation basis. Now it seems a little funny that if I have an opportunity to invest on a repatriation basis, why would I choose a non-repatriation basis? But the origin of this is as I said, this has come way back in 83, 84, and that's why it still continues to be there on the statute. Each NRI can purchase up to 5% of the paid up value or 5% of the value convertible of each series, and in case of all NRIs put together, the limit will be extended to 10%. Just like in the case of an FII, this limit can be increased by the company concerned to 24%, and the NRIs, but unlike an FII, who can, as we saw, do short selling, in the case of an NRI, he can only purchase and sell the shares on a delivery basis. There is a responsibility for reporting these transactions to the authorized dealer through whom this portfolio investment scheme is being operated, and it is an onerous responsibility, because that AD will then have the responsibility of telling the RBI what your percentage of investment is. And very often you will see circulars which will say and tell the authorized dealers that please do not allow any of your constituents to make investments in ABC Pharma Company, because it has already reached, the investment has already reached 22%, 21%. So they want to ensure that that 24% limit is not breached. And that is where this 24%, the authorized dealer has a responsibility. He in turn has to send all these reports of investments made by the NRI to the Reserve Bank from time to time. If you want to invest on a repatriable basis, non-repatriable basis, you can do that with your NRO accounts as well. And that is probably an avenue where somebody has a bank account lying here, wants to invest into the stock market. He can use the NRO account, because NRO, as you know, is always identified with non-repatriation, and then he can purchase and sell, and on that basis whatever is the amount which can be repatriated based after deduction of taxes and with the permission of the authorized dealer can be repatriated. You then have purchase and sale of shares or convertible debentures by NRIs on a non-repatriation basis. I made a reference to this when I was talking of a repatriation basis, by saying that why would somebody now want, in the current scenario when you can have a repatriation which is being allowed, and because here then the money can only be invested into the NRO account. But if you do not want your foreign funds to be used, when you want your rupee funds to be used, then maybe this may be a good way of using the portfolio investment scheme on a non-repatriation basis, because ultimately if the money which is credited to an NRO account, you also have this window of $1 million that you can repatriate every year. So if you are going to make good returns out of money which are lying here in India, that money can go into the NRO account, and ultimately from the NRO account you can repatriate that $1 million every year. So probably that is the only reason why there may still be an attraction for investment by an NRI on a non-repatriation basis. There are some prohibitions here, and these prohibitions you will find in a couple of regulations where investment is allowed on a non-repatriation basis, and that is to do with a chit fund or a nidhi company. Mind you, it is only for real estate business and not real estate development really. Construction may not fall within this term of real estate business, and other than that there is agriculture, plantation and TDR, which is generally not, which is out of bounds for foreign investment. We then move on to other investments, what is called Schedule 5. And as I said, I will not really take you through these other investments in great detail. It is mentioned there in the annexure, because for again the investors that we have already spoken of in the past, the FIIs, the QFIs, the NRIs, the RFPI, sorry, QFIs we haven't spoken of, but we will come to that later. All these, the window for investing in government securities, debt securities, ARC paper and all others is really regulated by Schedule 5. So earlier when we looked at Schedules 2, 2A, 3, 3 and 4, they were talking of investments in equity or equity linked other instruments like convertible debentures, which is treated as equity for the purpose of FDI. But when it comes to Schedule 5, Schedule 5 permits these type of investors. Again, the overriding point is that in terms of the SEBI and the RBI policy, which may fluctuate from time to time. So if you can always have, if the government feels that you are in a position to absorb more debt into the economy, they may free up the debt window and increase the amount of investment, which they keep on doing from time to time. Now they say that this amount of billion which is available to FIIs for investing in debt securities is now increased from 10 billion to 20, 20 to 30 and so on. And therefore by that micromanagement control, they can control the amount which goes into debt securities. For investment, they are not really bothered because they are welcoming foreign investment to come into India. But debt securities obviously comes in with a price, because you are getting a rate of return. That rate of return and that investment can be sent outside India. And whenever there is a pressure on the rupee, they would like to try and control this debt window. Whenever the rupee is appreciating significantly, the window will therefore be opened up or relaxed. And that is again a point of view that you will see across regulations. The loan scheme, which was earlier $25,000, was extended to $200,000 in somewhere in 2007-8, because at that point of time the rupee had started appreciating and had come down to as much as 39 rupees to the dollar. And that's why they immediately liberalized the loan scheme and said you can send up to $200,000 per family member, thereby encouraging people to invest outside. Last year when we saw the run on the rupee and the rupee went up to 65 and more than 65, they immediately clamped and put clamps and have brought down the loan scheme and the limits thereon. Similarly, in terms of debt securities also, what the government and the RBI does from time to time is that they restrict or they increase depending upon the whatever is the position in relation to the rupee. So you have FII, within Schedule 5 there is a para 1 which lays down what are the debt securities that an FII can invest in. In relation to QFI, you have a para 1A, para 1B, and the latest, which is the one relating to the RFPI, which was just announced this month, and that is para 1C. Then we move on to the next schedule, and that is the schedule relating to foreign venture capital investments. A foreign venture capital investor is an investor who is incorporated and established outside India and who wants to make investments in venture capital funds. So really, when you looked at the overall scheme of investment in India, you had an FDI, and then there was this FII, you had NRIs and somebody, NRIs as you know can come into the FDI as well. Everybody can really come into an FDI route directly if they want to play a part in actually the running of a company or any other enterprise. But you also had FIIs which came in only for earning a rate of return on investments or stock exchange or whatever it is in listed companies. Then you had the NRI scheme, where again NRIs were allowed to make and invest into Indian companies, and the RFPI which consolidates all those. Over and above that, as the economy started becoming mature, there was a demand by private equity players that also allow us a regime by which we can invest into Indian securities and through a kind of a single window, and that was what was called as the Foreign Venture Capital Investor Regulations. This is something which is governed by SEBI. Again, here if you see the regulations of the RBI have not really kept in pace with those of SEBI, because under SEBI all these are now part of what is called as alternative investment fund regulations, and those regulations have been notified. However, if you see schedules of FEMA, there is still a reference to venture capital fund, which is probably not existing anymore as in terms of SEBI. That gets merged into a category of an AIF. So AIF has three categories, out of which one category is a venture capital fund. So that is sometimes that you will get confused by why is this AIF, why somewhere it is mentioned foreign venture capital regulation. But as I said, there is often a time between RBI regulations and between SEBI, the SEBI and the government, and that is where there is this mismatch which often happens. Foreign venture capital investor regulations, important to note that in spite of the FVCI regulations, there may be a lot of large private equity players which may still want to come into India, not only through the foreign venture capital investor regulations, they may want to come into India directly into invest into India through the FDI route, or they may even prefer an FII route. And therefore, what typically a large number of these private equity funds do is that they have an entity outside India and they set up entities as an FII, as an FDI, and as an FVCI as well. Because you never know which regulation may help in which direction. As you may see in the case of an FVCI regulation, the 2-3 important points why a person would want to come in through an FCI regulation is one, that there is no guidelines in relation to the pricing. That becomes very important, because for a foreign private equity investor, if he has invested into a company and there is probably an assured rate of return which has been kind of agreed upon and he wants to exit, then if you have a DCF coming into play or any other regulation coming into play, that really impacts his exit route. And as you know, an DCF or a private equity is here only for helping a company earning a rate of return and getting out. And that is why that flexibility is given by the FVCI regulations. That if you come in through the FVCI route and you are regulated by this particular schedule, then you don't have what is the pricing guidelines which otherwise apply to foreign direct investors. But foreign direct investors, but if you come through the FVCI route, there may be some restrictions on certain sectors which you cannot really invest in. On the other hand, in the FDI, you can come in very freely into the sectors depending whatever the sector cap is. So you can come into a real estate sector if you are ready to have a project, invest in a project which has a minimum amount of acreage, which has minimum amount of capitalization. If you are ready to fulfill all that, you can come directly through the FDI route. If you are looking at investments in India, you can use an FVCI route in order to get the flexibility not only in relation to the pricing. Another important flexibility is that they don't have to hold those shares, which is a lock-in which is stipulated for promoters 1 year after the IPO. So that again is not required for an FVCI if you come in via the FCI regulation. So couple of these and some other procedural matters really then prompt these private equity and venture capital funds to set up not only an FDI company, maybe Singapore, Mauritius, as the case may be, also an FVCI company, and very often they also have an FII company. And why FII? Because at times now people have started using the FII route for investing into debt of an Indian company. Listed NCDs are allowed if an Indian company issues them to an FCD, which is like in a form of debt being given to a real estate player. And therefore they will have all these three, depending upon the transaction in India and whatever works the best. They would want to use either the entity which is registered under the FVCI regulation, the entity which is a pure FDI entity, or an entity which is registered under the FII regulations. So this is the broad picture in relation to the FVCI regulation. A venture capital undertaking, you must understand, is the entity in which the investment is made. So if you have read in the papers that a Blackstone has made an investment in CMS operations, then CMS operations here is the entity which is the venture capital undertaking, or the IVCU, which is the undertaking. A venture capital fund, as I mentioned, is defined under the regulation, but under the AIF now, under the alternative investment fund regulations, a venture capital fund becomes one of the three categories of funds and therefore there is no concept now of venture capital fund under the AIF regulations. It gets subsumed within an AIF, and therefore at times I have made a reference to either AIF or a venture capital fund. If you note, in terms of the venture capital fund definition, in a venture capital fund need not be only owned by a foreign company. You may have players like ICICI, Kotak and all others who want to float a venture capital fund in order to raise monies and then invest in investments. And therefore, as far as the VCF is concerned, it can be a domestic VCF or an FECI which has wanted to invest in these VCFs. This is the latest development on the AIF which I already did mention. This is from SEBI. This you will not find under the FEMA regulations, but clearly the AIF or fund interest ESOPs and all those which are meant for a special purpose will not be considered as alternative investment funds. Venture capital fund, as I already discussed, the regulation definition in FEMA is a little different from the AIF, and I am sure that FEMA also will make amendments soon. Venture capital undertaking, I made a reference to this, that this is, as I gave you the example, a CMS, an investment by a Blackstone into a CMS. CMS is what is called the venture capital undertaking. Interesting point here which now arises and which has been a controversy over the years is that when the FECI regulations came in and then SEBI allowed an FECI to be registered, as we see here, in terms of the SEBI regulations, you are allowed to probably invest in most sectors other than the non-banking finance, gold financing and other activities which are not permitted under the industrial policy of the government of India. However, people who started making applications to the RBI and to the government, what they often saw was that the RBI and the government used to give them approvals and restricting the investment only to 9 or 10 specified sectors. Now, where did these 9 or 10 sectors come from? This came from the provisions of Section 1023 FP of the Income Tax Act. Whereas you know, an income or venture capital fund is exempt if investments are made into venture capital undertakings and the various rules of the income tax are fulfilled. Income tax, there was an amendment made and they said that if you make an investment only in these sectors, we will give you the benefit under 1023 FB. Somehow taking a cue from that, the government and the RBI also only started allowing investments made in these sectors which were possible under the FCCI regulations and not others. It had no legal basis or sanction. But that's the way FEMA often operates. It is like Dadagiri. If the government says, this is what I want to do, or the RBI says, then you really don't have an option because they are the person who is giving you the regulation there. Funny part is, after in 2012, the Finance Act 2012, those restrictions in 1023 FD were done away with by the Income Tax Act, based on a representation made by the venture capital fund and the investors by saying that you cannot restrict us only to these particular sectors, because otherwise what started happening was that you had to have a for a venture capital which was only dedicated to these 9 sectors. So I talked of 3, then there had to be a 4th entity which had to be registered, one which was in the 1023 FD sectors and one which was other than the 1023 FD sectors. So things became more and more complicated, and the pass-through mechanism which was conceived under the Income Tax Act was not being fulfilled. And hence the Income Tax Act amendments were made, but these have not been really carried through. There is a lack of clarity. Now, as I understand, they are allowing it, but again they are subject to the old interpretations. In some recent cases they said you will not be allowed to invest into real estate. Maybe the logic is, as we see here, industrial policy, and under the industrial policy in force, if you want to get into a real estate project, there has to be a commitment for minimum capitalization as well as a particular acreage or area of project that has to be developed, and that venture capital, necessarily the project may not be satisfied, and an investment in a company which has several projects will be difficult to monitor. So RBI and the government have been saying we will not allow you to invest in those sectors. The SEBI venture capital funds regulations stand repealed and they now get reflected into the AIF. I need to make a reference to that. This is essentially the regulatory framework the SEBI Foreign Venture Capital Investor Regulations, the SEBI Alternative Fund Regulations, and the investment by registered FVCI under FEMA. So under FEMA there is this schedule that we spoke of, Schedule 6, which governs whatever it is, references made to venture capital fund, maybe a little otiose now in view of the AIF regulations. But that is the way of the scheme of the act. What can an FVCI do? An FVCI can invest into equity instruments, debt instruments. That is all contained within Schedule 6. But what Schedule 6 doesn't say, and what the government policy of 2014 says, which has come in April 17, 2014, that they can also contribute to a 100% of the capital, which is okay, and they can set up a domestic asset management company to set up a fund. So this is something which has learned only as a result of the FDI policy, which was probably not there in clearly black and white in the schedule. But that's why, as I said, you have to read the policy of the FDI and the RBI circular and the schedule, all three put together. Remember, the schedule is really the law, but the policy now says this, and hopefully RBI also in the course of time will amend the regulation to reflect this. A SEBI registered FVCI can also invest into a domestic venture capital fund. If the venture capital is open for resident investors, it can also be open for non-resident investors. A SEBI registered FVCI which has got approval from the RBI can then invest into this. That would be regulated by the RBI regulation and the policy. FVCIs are also allowed to invest into eligible securities and debt securities, again in terms of Schedule 6, which is specified. There is a reference made to the annexure. And of course, registered FVCIs can also make investments directly into the stock exchange. And as you know, a lot of foreign private equity investors have invested into pipe deals. Most of them in the last few years have only made investments into listed entities because the rate of return there probably was better, and they have an easy exit route as opposed to a listed company, and where probably the valuations that were being demanded or the amounts that were being demanded by Indian promoters was too high in comparison to what the private equity capital investors wanted. And that is why there are a lot of these pipe deals, as they are called, which means investment into the stock exchange or securities which is in the stock exchange. And therefore you must have read of many private equity investors, they may invest up to 20% and so on within the limits of whatever is the SEBI takeover code law at that point of time, because they don't want to breach the SEBI takeover code and make an open offer. So they would try and see that that investment that they make is both within the SEBI takeover code and also designed to give them a return. Payment has to be made from inward remittances. A forward cover is permitted. As I said, the highlight of the FVCI really is the departure from the normal schedule, which is the requirement of having to sell shares at the discounted cash flow method. So that is one of the main incentives or sweeteners for a person to come in and register as an FVCI, apart from that 1 year lock-in period which is available for an FVCI. And then move on to Indian depository receipts. And Indian depository receipts, as I said, it really deals with receipts which could be made in the Indian stock exchange. So take an example of an American depository receipt. So what happens, an Indian company issues the shares. So the underlying capital is the Indian share capital. Against those shares, there is a depository receipt which is created by a banker in any of your jurisdictions, maybe Luxembourg, UK, or wherever the case may be. And those depository receipts, which become virtually like an instrument, are then issued to non-resident investors who don't invest into Indian capital but invest into depository receipts outside India. Those depository receipts are then freely traded. Under the Income Tax Act, transfers of those depository receipts are not taxable by a specific exemption under 47, and therefore depository receipts trading again helps non-resident investment, because the underlying share capital is actually flows back to the Indian company and is a way of attracting investment. There was probably a demand for foreign companies also to tap the Indian markets, and therefore this probably was created, and there was only one issue, as I said, which I am aware of, the Standard Chartered issue. which has gone in for an IDR, where Standard Chartered